We've got Vivek Rajpal, who's a rate strategist at Nomura India, joining us on the show. Vivek, our earlier guest just mentioned that he expects the Reserve Bank of India to cut rates by something like 150 basis points in the current financial year. What's the Nomura expectation?
Nomura baseline expectation is another 50 basis points of cut. However, Nomura expects growth to pick up slightly. So, given that we are expecting growth has bottomed out and will pick up from here, we have a relatively muted expectations in the previous guess. We expect another 50 basis point of cut from here on.
All right. Now, Vivek, just focusing on the liquidity picture that we are seeing in the markets. It's running at something like 75 to 80,000 crores. Earlier, you had most of your colleagues in the industry saying that, at least this week we expect some sort of OMO announcement coming from the Reserve Bank of India. But to the extent that you had Subir Gokran just say a couple of days back that the RBI is comfortable with the current deficit position, is the fixed income market somewhere working in this this expectation that you aren't going to see OMOs in the near term at least?
So, basically at the moment, as you have rightly pointed out, the total system liquidity deficit is around INR 750 billion. And given the call rates are trading very close to the repo rate, there is just a spread of 15 to 20 basis point over repo rate, which effectively means that liquidity conditions are comfortable. Even the outlook looks comfortable in the near term for next 3 months, because the currency in circulation, which is a drag on liquidity, will remain low. In fact, this is the period, June, July is the period when currency comes back into the banking system. So that will rather add liquidity into the system. So as such, because the total system liquidity deficit is close to 1% NDTL, there is no need of open market operations. However, the bond yields will be supported by the rate cuts rather than OMOs from here on. So that's the key point.
So do you think then perhaps that the bond yields would also need the help of the cash injection in terms of OMO plus a rate cut by the RBI in order to ease the liquidity?
Given liquidity deficit is INR 750 billion, and unless there is a FX intervention, there is no need to inject extra liquidity. So we our base case is that RBI will go ahead with repo rate cut rather than a CRR cut. And this repo rate cut in itself will keep the bond yields at current levels.
Right now, Vivek, what's the Nomura expectation in terms of the timing of the cut? Because earlier you had pretty much everyone in your fraternity saying that you would see those additional rate cuts maybe come only by October. But after the GDP numbers, most people are reworking their expectation to a June 18th rate cut. Is that the same view at Nomura?
Yes. Our economic team is expecting a 25 basis point of rate cut on June 18. So yes, we are also in that camp.
And you'd see another 25 in October then?
Another 25 is something which our economics team is expecting in the second half of the year. Having said that, if growth numbers continue to surprise on the downside, if, for example, the global commodity prices have come down, so core inflation may continue to remain subdued, that may allow RBI to front load the rate cuts. However, as of now, the base case is that we'll get another cut towards the second half.
What is the range that you're foreseeing for the yield on the 10-year bond?
So given that we have a new 10-year benchmark that will come this Friday, which should trade at a premium versus the older benchmark, I think it should come closer to 825 levels. So, and given that the macro backdrop is relatively favorable for rates, I would assume 825 is a fair level. However, over the period over next couple of months or so, I won't be surprised if it reaches 8% target. So officially, we also have a 8% target on 10-year benchmark 3 months down the line.
All right, and Vivek, just before we let you go, a quick word on the rupee. Where do you see it going?
So rupee at the moment is back to the driver is again the global backdrop. We are at an important time as such. We have a ECB, then we have a Fed, we also have Reserve Bank of India in between. So the way global environment behaves from here, the rupee will take that kind of a cue. As such, we see for next couple of months, rupee will remain in pressure. However, towards the second half of the year, we see gradual appreciation in rupee.